As of Thursday, March 19, 2026 at 1:15 p.m. IST, the Rezolve AI stock, RZLV, is currently trading at a closing price of $2.65 following a downward intraday movement of 6.36% during the most recent U.S. trading session. The market is currently closed, with the last session on March 18, 2026 ending with a notable slide that brought the stock to the bottom of its daily range. While many retail investors looking through their Robinhood app might see this as just another volatile dip in a high-risk sector, there is an underlying story here that the surface-level numbers are completely missing. The gap between what the market believes Rezolve is worth and the actual revenue it is already locked in is becoming one of the most significant anomalies in the tech sector today. If you look at the broad sentiment across social media or general investment sites, you will hear a lot of noise about small-cap volatility and the risks of betting on unproven players, but the reality is that Rezolve AI has quietly transformed its balance sheet while the price action suggests otherwise. Expectations for this company have historically been tied to its status as a speculative AI play, but the reality of its recent $230 million acquisition of Reward Loyalty UK changes the entire narrative. This wasn't just an expansion move, it was a structural shift that theoretically brings Rezolve into a state of immediate profitability and massive scale. Yet, despite management guiding for $350 million in revenue for 2026, the stock is currently sitting nearly 70% below its highs of last September. This creates a massive tension for anyone involved in online investing. On one hand, you have the show-me state of the market, where investors are tired of promises and want to see the actual cash flow. On the other hand, you have institutional giants like Goldman Sachs and State Street significantly increasing their positions in the last quarter. Goldman alone grew its position by over 340%, which tells you that the smart money is seeing something that the retail crowd, often distracted by daily price swings on the SoFi trading platform or interactive brokers, is completely ignoring. When we talk about Nvidia stock or Apple stock, we are talking about established giants where the growth is priced to perfection. With Rezolve AI, we are looking at a company that is essentially being priced as a failing startup despite having $209 million in annual recurring revenue already contracted for 2026. That is a massive disconnect. Most people using an intelligent portfolio or seeking investment help from a robo-advisor won't even have this stock on their radar because it doesn't fit the standard profile of a stable tech asset. But for those who manage their own individual brokerage accounts and engage in self-investing, this is the kind of setup that defines a career. The expectation is that Rezolve will struggle to integrate its new acquisitions and burn through its cash. The reality is that the company just closed a $250 million financing round and enters 2026 with one of the strongest balance sheets in the AI commerce space. They are not just surviving, they are positioning themselves to be the control layer for how we actually buy things using AI agents. The recent price action, specifically that 6.36% drop to $2.65, reflects a broader lack of liquidity and a general fear in the small-cap market. If you are watching this on a Fidelity mobile app, you might see the high volatility and think the company is in trouble. However, the volume during these dips is often quite low compared to the massive institutional accumulation we saw in late 2025. Institutional activity is the hidden hand here. When firms like Alyeska Investment Group establish stakes worth over $120 million, they aren't looking for a quick 10% flip. They are looking at the same 2026 revenue guidance that implies nearly 10x year-over-year growth. Comment below how many shares of Rezolve AI you currently hold, or if you were waiting for it to break back above its 50-day moving average before entering. To understand why the market is reacting this way, you have to look at the psychology of the modern trader. People using Robinhood Investments or the SoFi Active Investing app are often looking for immediate momentum. Rezolve AI had that momentum last year when it hit $8.45, but as the hype cycle cooled, the tourist investors left. What remains is a core group of institutional holders and a business model that is finally starting to fire on all cylinders. The company's brain suite is designed for what they call Agentic Commerce. Unlike traditional search where you type a query and get a list of links, Agentic Commerce allows an AI to actually perform the transaction, handle the fulfillment, and personalize the experience without the user having to jump through hoops. This is the same space where Amazon is spending billions, yet Rezolve is a pure play in this specific niche. If we look at the competition, companies like Palantir or even Salesforce are trading at massive multiples because they have proven they can scale. Rezolve is currently trading at a fraction of its projected revenue. This is where the tension becomes a choice. If the company hits its $350 million revenue target for 2026, the current market cap of just over $1.1 billion is going to look absurdly cheap. However, if they miss, or if the integration of Reward Loyalty UK becomes a drag on the bottom line, the bears will argue that the company was always just a collection of expensive parts. This is why the trading volume is so important to watch. We are seeing a bottom bounce formation where the stock is finding support around the $2.50 to $2.70 level. On the Fidelity trading platform, technical analysts are noting that while the 200-day moving average is still quite high at $3.76, the short-term RSI is starting to show that the stock is oversold. Now, let's step back and look at the company's history for a moment to see how it got here. Rezolve AI was founded back in 2016, and they spent years building the plumbing for mobile-first commerce. Their platform uses things like NFC-enabled tags and QR codes to turn passive browsing into active engagement. They basically want to make every digital touchpoint a place where a sale can happen instantly. It's a single-tap philosophy. For years, this was a niche idea, but with the recent explosion in generative AI, their brain platform suddenly became relevant to much larger enterprises. They've managed to secure partnerships with Microsoft and Google, which usually acts as a massive stamp of approval for a tech company of this size. Despite this, the stock has been thrashed. It's a classic case of a company outperforming its stock price. When management hosted their investor call in January, they were very direct about this. They basically told the market that analyst estimates were too low. They were looking at $171 million in consensus revenue, while the company already had $209 million in contracted revenue. That is a rare situation. Usually, companies are trying to hide the fact that they are missing targets. Rezolve is doing the opposite. They are trying to get the market to wake up to the fact that they are beating them. But the market is a stubborn thing. It often takes a few quarters of reported, audited results before the narrative shifts. For those who use Fidelity Wealth Management or have their funds in Fidelity Mutual Funds, you likely won't see direct exposure to Rezolve AI unless you are in a micro-cap or small-cap growth fund like the iShares Russell 2000 Growth ETF. It's a risk-on asset. But if you are someone who likes to invest online through a self-directed account, the current price represents a point where the downside is beginning to be capped by the sheer value of the cash and contracted revenue on the books. We have a company with a $1.1 billion market cap that just raised $250 million in cash and expects $350 million in revenue. The math is starting to become very compelling. The risks, of course, are not trivial. Integration risk is the big one. Buying a company like Reward Loyalty UK for $230 million is a massive bite for a company of Rezolve's size. If they can't successfully merge the technologies or if they lose key talent during the transition, the projected synergies won't materialize. Also, the macro environment remains a factor. If we see a broader tech sell-off affecting even the giants like Nvidia stock or Tesla stock, small-cap AI plays will be the first to be liquidated. But this is where the expectation versus reality framing comes back in. The expectation is that Rezolve is just another AI penny stock that will fade away. The reality is that they have built a platform that global banks and retailers are actually using. As we move toward the middle of 2026, the catalysts to watch are the quarterly earnings reports. We need to see if the December profitability was a one-time event or the start of a trend. If Rezolve can show consistent EBITDA growth alongside their revenue explosion, the stock won't stay under $3 for long. Analysts at H.C. Wainwright and Cantor Fitzgerald still have price targets ranging from $8 to $12, which implies a potential triple or quadruple from current levels. Even the more conservative, moderate buy ratings suggest significant upside. In conclusion, Rezolve AI is a study in market inefficiency. You have a company that is growing at a triple-digit pace, has secured massive institutional backing, and is operating in one of the hottest sectors in the world, yet its stock is trading near all-time lows. The disconnect is fueled by a lack of awareness and a general skepticism towards small-cap tech. But for the